Good morning, everyone. I'm Ken Leon, Director of Equity Research, and I'll be your moderator today for Outlook 2023, A Tale of Two Halves. I am really delighted to have two great presenters from CFRA, Sam Stovall, Chief Investment Strategist, and Vincent Randazzo, who's Head of Technical Research. Here's our standard fare disclaimers, if you can take a look at them for a moment. For those who aren't familiar with CFRA, and this is a slide we have on all of our webinars, it's really to show you the breadth and depth of CFRA research. CFRA research has been around for a long time, but the velocity and scale of our business really expanded back in 2016 with the acquisition of the S&P Equity and Fund Research Group. We subsequently acquired First Bridge Data, which gave us world-class platform for ETF and then mutual funds. And Vincent is part of the acquisition we had of Lowry Research, one of the top 2 or 3 technical research teams, on the street. And then we were pleased to bring in Washington Analysis, a fairly large team, which is looked upon for their research and for their events related to policy and regulation. So put it all together, CFRA is one of the largest independent research firms in the world. So the recipe or the engine really for our research is really each of the groups that I've mentioned, really distilling data and analytics and collaborating either within their own teams or across to the other disciplines to come up with observations, insights, and investment recommendations. Sam leads our investment policy committee and leads the sector views that you'll hear from him. It's the top-down perspective that's so important to each of you, but also marrying that with the bottom-up research that our analysts do, covering 1,500 stocks worldwide. And in addition to doing the standard fare company and industry research, we probably take most pride in our thematic research, which brings the most important topics of the day or the trends. All these can be seen on Market Scope Advisor, along with ETF and mutual fund research. I also want to mention our institutional team in forensic accounting that also do, their detailed, complex accounting reviews to come up where sometimes there's shortcomings or weaknesses in companies. All that helps the rest of research. Additionally, we're always looking for ways to provide idea generation, even in terms of client engagement or webinars. So it's really an exciting place to be today, and we're certainly looking forward to 2023. And that might be a good segue now to get to our program today, moving to Sam Stovall, looking across the valley. Good morning, Sam.
Good morning, Ken. Good morning, everybody. Thank you for tuning in. Yes, I do think it's going to be a tale of two halves, with the second half being the more optimistic of the two as investors look across the valley. To sort of set the stage, however, I guess I don't have to really remind investors too much about what happened in 2022. Yes, we endured a bear market with the S&P 500 and 10-year treasuries falling by 25% each. Actually, the first time in 50 years in which both 10-year treasuries and the market fell on a calendar year basis. Small caps and the NASDAQ each slumped by more than 30%. The Fed raised the Fed funds rate 6 times through the end of November by a total of 375 percentage points, or actually I should say 375 basis points. And today we think the Fed will announce a 50 basis point increase to the Fed funds rate. U.S. GDP growth estimates declined sharply as the year progressed, from as much as 4.6% to closer to 1% for all of 2022. And we still have the risk of recession overhanging investors, as well as geopolitical tensions between Russia and Ukraine, Iran, China, North Korea, etc. As a result of all of this tension and volatility, we've seen stocks that were pressured by soaring inflation, rising interest rates, the strengthening dollar. And as a result, from January 3rd through October 12th, we had all sizes, all styles, 10 of 11 sectors in negative territory, as well as 89% of the 148 sub-industries within the S&P 1500. Energy was the big winner, up more than 40%, and your traditional defensive sectors, consumer staples, utilities, healthcare, fell the least, so therefore being relative outperformers, whereas your traditional growth and high interest areas like discretionary, communication services, technology, and real estate fell the furthest. So now the question is, what happens going into 2023? In a sense, what could go right and what could go wrong? And then taking that one step further, based on what could go right and wrong, when might it likely occur? So our guesstimate is that in the first half of 2023, maybe we do see a lower low, or at least a retest of the October 12th low. One reason being that, we have the risk of recession ahead of us, whether it is because of the still high, though declining CPI level, deeply inverted yield curve, possible earnings recession, continued defensive sector posturing with the defensive stocks, the shallowness in terms of decline, in terms of duration, in terms of how much of the prior bull it took back. And then lastly, the absence of a price capitulation spike, something that we normally see that sort of serves as a lap bell for the end of a bear market. Second half, what about the beginning of a new market, or a new bull market, or even a continuation of what we've been experiencing so far? History tells us we should be encouraged by continuing to own a 60-40 portfolio. We are in that sweet spot in the 12 months after midterm elections, and we have started to see a favorable relative sector rotation. Maybe we end up seeing an easing of geopolitical tensions between Russia, Ukraine, the easing of the lockdown in China, etc. Because we're getting closer to the end of the rate hiking cycle, does that mean that the value of the US dollar is topping out? And then will the Fed actually start to lower interest rates as we approach the end of 2023? So certainly questions that abound, and trying to put them into a time frame makes them even a little more challenging, but that's something that investors want us to do. In terms of economic growth activities, the question is, do we have further to fall? Action Economics, which is the provider of our economic research services, they started the year thinking we're going to see a 4.6% gain in real GDP in 2022. Today, that number is less than 2%. And as we head into 2023, it's going to be around 1%. Advanced economies also likely to show the greatest decline, but emerging markets actually showing a slight improvement. Canada, Europe, Japan also likely to see a decline, but China expected to see an improvement in economic activity. So the real question is, do we end up with a soft landing, or do we end up with a recession? Our economists are saying a soft landing. History, however, says more likely a recession. I say that because this chart is simply a year-over-year percent change in headline CPI. So just downloading this data from the Bureau of Labor Statistics, you can produce this chart on your own. What it shows are 1 and 2 standard deviations from the mean. In the blue shading are bear markets, and in the orange shadings are recessions. And essentially, every time that we have seen the headline CPI rise above 6% on a year-over-year basis, we have fallen into both a bear market accompanied by a recession. No guarantee that that's going to happen this time, but certainly when it's happened so many times going back to World War II, at least one should be prepared for the possibility for a recession to occur this time as well. Why should we worry about having a recession tagged with a bear market? Well, essentially because bear markets associated with recessions have lasted longer and have fallen further than those not associated with bear market or with recessions. And also what we're seeing is that on average, the percent decline has been 35% for bear markets with recessions versus 28% for bear markets without recessions. We've also seen the duration, 15 months as compared with 6 months. PEs have fallen by a similar amount, about 1/3, trimming of the PE from the beginning of the bear market to its trough. And we've also seen on average a year-on-year reading for headline CPI peaking at an average of 7.1%. Ours most recently in June at 9.1%, still below what we saw in the mid-70s and the very early 1980s. So something that we have to consider, that there is still the possibility that we will be falling into a recession. Another indicator is the yield curve. This, again, is simply the 10-year yield minus the 2-year yield, and we are now sharply in an inverted state, and actually a level that has not been seen since the early 1980s, just a shade above 2 standard deviations below the mean. So certainly a level that I think would cause investors to be concerned that here is another indication that we are getting close to a recession. What is not shown is that the leading economic indicators are also negative year over year, and that has typically been a pretty good predictor of an economic recession. Another is looking at the year-on-year percent change in operating earnings. Well, at least operating earnings since 1990, GAAP earnings before that. But traditionally, whenever we go negative, we have typically fallen into recession. Not every time. You can see back around 1966, 67, we did have a dip in earnings, and we had to wait until 1970 to fall into that recession. But more times than not, if we do end up falling into an earnings recession, the economy tends to fall into recession as well. Right now, we're showing is S&P Capital IQ consensus estimate forecasts. The blue line is the estimates for the full year of 2022. Basically, what is the earnings growth for that full calendar year according to these consensus estimates? And obviously coming down quite dramatically from the more than 9% reading toward the middle part of June down to about the 5% reading as we're looking at right now. Also, we're seeing a pretty sharp erosion in estimates for 2023. So again, there are concerns that investors have that we have to shake off an awful lot of this overvaluation. We probably have not seen the end of the trimming of earnings estimates and the possibility of us slipping into an earnings recession. Taking this one step further, looking at valuations today as compared with the average going back to 2000 for the S&P 500 and its sectors, going back to 2005 for the S&P 500 growth and value indices. What you see is that the S&P, actually, this chart was created on Monday, but today the PE is above 18. So we're looking at a more than 6-7% premium to the average over the last 22 years. We're also looking at very expensive consumer staples at 19% premium to its long-term average, and utilities even more so, a 28% premium. But the question, gee, should I be bailing out of energy because energy has done so well over the last couple of years? Well, right now, they're still trading at a more than 50% discount to its long-term average. So essentially, the market is saying no, even though energy has done quite well, that there is the likelihood that it could continue to do well in the period ahead. One of the things that I like to look at is momentum. I look at the technicals, and I'm very appreciative that Lowry is part of the CFRA team right now. I put together a very simple portfolio of S&P ETFs, sector ETFs, and using the power ratings for each of these indices within Lowry, we can see that those groups that are exhibiting the greatest near-term momentum are still the defensive areas: consumer staples, healthcare, utilities, industrials sort of eking their way higher, and then materials and energy sort of in the middle, along with financials. Yet still in the lower regions are the high growth, high PE areas, such as consumer discretionary, communication services, tech, and real estate. Taking that one step further and saying, well, gee, if we did actually monitor it, would it actually add value to our portfolio? Using a very simple 40-week or basically 200-day price performance at the end of every month, looking to see which of the 4 best performing sectors and the 4 worst performing sectors. Here I show them based on the equal weight 500, mid cap 400, small cap 600. Right now, communication services, consumer discretionary, tech, and real estate are those with the lowest groupings, lowest 40-week relative strength, whereas staples, energy, industrials, and utilities have the highest. If you were to, at the end of each month, either own all 4 in equal proportion of the best or all 4 in the worst, how would you have done? Year to date, you can see the performance for the 500, 400, 600. Doesn't mean that you'd be positive all the time, but in this case, it shows the top 4 sectors were down 1.4%, benchmark down 10.4% through the other day. Bottom 4 sectors down 17.4. So essentially, refreshing your portfolio at the end of each month. This is the kind of return you would have experienced year to date, as well as on a 3-year compound annual growth basis. So taking a look at the Lowry power ratings certainly is something that could be beneficial. One of the things that also sort of bothers me, if you will, but is not a guarantee that the bear market has not ended, is that this bear market really didn't last as long as even the average. The average bear market since 1946 was in existence 382 days from peak to trough. Ours was this most recent one was only 282 days. Even if you say, well, I'm only going to look at what's called garden variety bear markets, or 20 to 40% declines, the average is 323 days. So still a below average duration of a bear market. The total decline at 25%, certainly below the average of 32% for all bear markets since World War II, and 28% for all garden variety bear markets. That's close, so maybe I shouldn't worry too much about that. Prior give back, meaning we took back 48% in this most recent bear market of the prior bull market advance, versus that average 67% for all bears since World War II and 58% for all garden variety bear markets. So again, you could say that this bear has been light in terms of decline, duration, and give back. But now, in a sense, the question is, okay, we've mentioned all of the negative things that could occur going forward. Well, once we get them out of the way, what do we have to look forward to? Well, the interesting thing is that maybe 2023 could be the beginning of a new bull market, not just for U.S. equities, but for balanced portfolios as well. Here is the Fidelity Balanced Fund, one whose history goes back to 1987. I chose that one because it does have the very long track record that I could pull off of S&P Capital IQ data. Interesting thing is that while the average annual return for every year since 1988 was 4%, in the year after a decline, it was up 9.6%. Also, the portfolio rose in price about 3 out of every 4 years that it was down. So chances are, and certainly not a guarantee, that when you do have a negative year in a balanced portfolio, that you do end up recovering in the year after. Also, for those who do look to presidential stock performances, 4 years of the presidential cycle, from October 31 of the midterm election year through October 31 of the following year, the S&P 500 has posted a positive total return 100% of the time, and the average total return was 21%. Even when the presidential party lost a majority in one or both houses, as we saw this year, history essentially says we've still had a positive performance. So one could then extrapolate and say maybe there's the possibility that we end up with a positive return this time as well. So specifically, which have been the leaders, which have been the laggards in the year of October 31 of midterm election years through October 31 of the year after? Well, you can see that the market tends to gravitate toward growth. The NASDAQ Composite posted the highest average return going back to 1992. S&P 500 growth was up there along with technology, consumer discretionary, whereas you find that energy, consumer staples, utilities, sort of the defensive plays did not do that well. And communication services was also among the laggards because that is really representing the old telecom services that was comprised of the baby bells. And then on the right-hand side, you can see that 96% of the sub-industries in existence since 1992 were positive in those 12 months, with a majority of them coming from the technology and the consumer areas. So what is happening today? Are we seeing a rotation? And the answer is yes. Looking at a rolling 40-week relative strength between the equal weight S&P 500 consumer discretionary sector versus the 500 itself, you can see that it bottomed well below one standard deviation below the mean and is coming up to that 100 level. Anything above 100 is outperforming the market over a 40-week period. Anything below 100 is underperforming over a 40-week period. And the orange smooth line is a 26-week moving average. So we see that the relative strength line is moving higher, so is the moving average. Conversely, we see that while consumer staples is still doing fairly well on a 40-week relative strength basis, it has already peaked, and its moving average has peaked. So possibly as the year progresses, we could continue to see investors move more toward the higher beta areas. Ditto for small cap stocks and for growth versus value. Certainly with the small caps, we see that they bottomed out in the early part of 2022 and have worked their way higher along with their moving average. Whereas on the right-hand side, we're not really seeing growth start to improve versus value. But if you look and see that essentially the growth is about 2 standard deviations below the mean relative to value, if you are a believer in reversion to the mean, there could be a very nice opportunity lying ahead. What could be the trigger for that opportunity? Well, if the Fed actually starts to lower interest rates, that could be very beneficial for the market. This shows you, the gray bars show you the stock performance going back to World War II during all periods. So 1 month, 3 months, 6 month, 12-month price returns of 1.5%, 2.5%, 6%, and 9.7%. But when the Fed is raising interest rates, the orange bars show you declines in 1 month and 3 months on average. Anemic advances 6 months and not so great 12 months after. Whereas the blue bars show how does the market perform typically in the 1, 3, 6, and 12 months after the Fed starts to cut interest rates. So that, in a sense, could be the incentive for equity prices going forward. Also, I like to say when life gives you lemons, make whiskey sours. What is some optimistic outcomes that you can have when looking at stock market data? I find that stock market data tends to serve as virtual Valium, as a way to calm investors' nerves. Because when you look to each of these bear markets associated with recessions since World War II, it's taken only 3 months on average to go from the bear market bottom up 20% and thereby signaling a new bull market. And in 5 of these observations, the time was essentially 1 month. The far right-hand column shows how has the market performed 12 months after these bear market bottoms, and the average is 47%. So a lot to look forward to if the market has already bottomed, or should the market bottom in the first quarter of 2023, what to look forward to. And then finally, questions have always arisen. Do I buy the losers or do I buy the winners during the most recent bear market? History says you want to actually own the worst performers during the bear market because they tend to recover the quickest in the 12 months after the beginning of the new bull market. So going back to the early 1990s, looking at declines of 15% or more, because I wanted to make sure I had enough observations to make this worthwhile, what we find is that if you bought in equal proportion those sectors that were the worst performers during the market decline, in the 12 months after that decline bottom, they were up an average 50% versus the market's 43%. And these 4 sectors on average beat the market 88% of the time. In terms of the 10 worst sub-industries, they gained 92% on average moving forward and beat the market 3 out of every 4 times. Yet, knowing that a rising tide lifts all boats, you can still see positive returns for those 4 sectors and 10 sub-industries that held up best during the bear market, but they don't tend to outperform the market in the 12 months after that bottom. We see that the 4 sectors, so this time around it would be consumer staples, healthcare, utilities, energy, those 4, history says will probably not be outperformers either on an average price change basis, and we see in terms of a frequency of outperformance, a batting average, they struck out every time. Ditto for the sub-industries, up 26%, similar average to the sectors, and also not beating the market in any one of these observations. So in summary, as we head into the first half of 2023, yes, we are still contending with a rising risk of recession. The stock market bottom might not be in. And if it is in, we might end up having to retest that October 12th bottom. As a result, we'll probably continue to have elevated volatility in the first half. In all of 2022 through November 30th, we had 115 days in which the S&P was higher or lower by 1% in a single day, which is more than twice the average of 51 since World War II. We think that the Fed will raise rates 50 basis points today, 50 in February, 25 in March. They will pause and then possibly start cutting rates late in the 4th quarter of 2023. As a result, investors will look across the valley once the Fed does decide to start to hit the pause button. We probably will see the market recover as a result of that, which would be a positive in terms of when the bear market bottom occurred, or certainly in the year after midterm elections. We could end up seeing a worst to first scenario in terms of sector rotation. And looking at the market cap weighted target price differentials put on by CFRA equity analysts, as well as technical analysis, we have come up with a 12-month target for the S&P 500 of 45.75. I see that there are questions building out there, but we're going to hold on to them until we hear from Vincent Randazzo, who now will take over from the long-winded Sam Stovall, and Vincent will talk about his outlook from a technical perspective.
Excellent. Thanks, Sam, and thanks everyone for tuning in. That was really great perspective and information. And in my segment, not out of the woods yet, I'll review Lowry's outlook for 2022. In hindsight, touching on the evidence suggesting a bear market this time last year, and get into what the current evidence from our point of view is telling us, as well as how to play it. The first slide will lay out how we operate, being more than just the market call that we've been known for since 1938. So I really wanted to start by highlighting Lowry's top-down approach here, where regardless of the market environment, the goal is always to help clients increase the probabilities of success based on real market data, not predictions, not opinions. We do this by identifying the sectors and industry groups with the best demand and relative strength profiles, providing proprietary demand and relative strength figures for literally thousands of stocks and ETFs. And the website is set up so that you can click through the sectors to the industry groups that make up those sectors, and then onto the stocks that make up the group. We'll get into this later, but let's go to the next slide, looking back and taking into account for our outlook as we headed into 2022 to see how we did and what's changed. And these are actually the bullets taken right out from my Lowry year-end presentation produced on January 13th of this year. Going into 2022, we saw evidence of significant internal deterioration, and we were waiting further confirmation of a bear market from specific indicators. And we got that confirmation actually within a couple of weeks of publishing originally. And Lowry also highlighted the relative weakness in small caps and observed higher probabilities of outperformance, mostly from defensive and inflation hedged sectors. So while it's been anything but an easy year, it was actually made more manageable, having been prepared for a change in the market's dominant trend. Now, next slide, I'm going to cover some of why we take the approach that we do and how Lowry saw the bear market coming in the first place. And I think first you have to understand that among the core tenets of a Lowry analysis is that prices alone by themselves can be misleading. And that's to say, because the major stock market indexes are either market cap weighted or mega cap weighted in the case of the Dow, they provide an inaccurate view of the overall market's health. And the primary reason is that these large cap stocks that drive the indexes tend to be the last stocks sold as bear markets evolve. In the most recent example of an important market top early this year, we can see that small caps basically did nothing for a lot of 2021, while large caps just marched right on until January of this year. And this is why Lowry looks behind the movements in these price indexes. On this next chart, we'll go over the first factor that allows us to peek under the surface of price, and that's market breadth. What we see in our market cap segmented advanced decline lines, which measure how many stocks are advancing versus declining within each segment, is that dwindling small cap breadth began in summer of 2021. And that reflected really the start of a market topping process. Historically, small caps being the most sensitive, both to changes in the market and risk tolerance and changes in the economy, are the first to demonstrate demand losses. And that's why we often refer to them as the canaries in the market, like the old canaries in the coal mine. In the bottom panel here, we can see that Lowry's operating companies only, or OCO, small cap advanced decline line, had been falling since June of 21, telling us that most small caps had fallen into downtrends. This was another clear sign of risk-averse behavior and narrowing in stock participation that typically leads to both corrective and bull market tops. In this case, weakness followed a classic pattern spreading, as you can see from this chart, from the smalls to the mids, then large caps, ultimately culminating in a bear market that is still underway. Now I'll go over breadth now and what it's telling us about the market's current state. When you evaluate market price index behavior alone, the problem for some investors is it's really impossible for them to see that those gains are not necessarily representative of the broader stock market. Right now, I think the starkest way to envision this gap between the perceived and actual health of the market is by looking at the Dow Jones relative to the NYSE All Issues Advanced Decline line at their late November / early December highs relative to their mid-August peaks. I think this is especially powerful evidence considering that the Dow's late November high actually exceeded its August peak, meaning that price made a higher high. And because breadth did not, very clearly did not, this negative divergence really reflects the view that the largest and the most well-known stocks were mainly propelling the major price indexes recently. But since breadth has its own limitations, on the next slide, we'll also incorporate our proprietary measures of investor demand and supply. So we'll start by revisiting the situation into late last year and then the current view. So another way of gaining a clearer view of the market's most likely course is by examining the drivers of price. And this is really simple as it sounds. It's just the forces of demand and supply. Lowry's buying power index is our measure of intermediate term demand, and the selling pressure index gauges supply. So again, really simple, but these disaggregated views of the drivers of price allow us to see where the vulnerabilities or the strengths lie and which factors are more responsible for price movements. So in this snapshot, we see that selling pressure had established a multi-month uptrend well ahead of the start of 2022. And honestly, this is typical ahead of bear markets. This is what you would expect to see under the surface. A Lowry intermediate trend sell signal was ultimately registered on January 18th and followed a week later by a new high in selling pressure. And per that first slide we had, our outlook published a week before that, these were among the pieces of evidence we had actually looked at and said, this is what we're looking for to make that call for a deeper, more protracted market downtrend. Now, when we look at the next slide, I'll update this chart with the current positions in buying power and selling pressure. And here, I think we can think about buying power and selling pressure as really offering, again, insight into the strength of advances under the surface of those sometimes deceiving major price indexes. In essence, buying power measures the conviction of buyers and selling pressure just measures that of sellers, right? Their longer term trends, along with other key indicators, contribute to the wave of evidence, and that body of evidence continues to reflect an uncertain and unhealthy market condition. But on a short-term basis, as you can see here, since their respective October 14th inflection points, buying power only rose about 38 points to its most recent high on November 11th, while selling pressure declined only 33 points to its December 2nd low. And this represents, if you just look at the chart and that divergence there, this represents a big lag between what's going on under the surface, those drivers of price, and what the price index is actually telling you. So the other problem is when you look at this rally compared to the summer's market advance, that advance this summer was driven by much more substantial changes in buying power and selling pressure. So let's just give you some numbers. From their respective lows and highs in July, buying power gained 53 points, while selling pressure crashed about 83 points. And that was by the rally peak in August, on August 16th. And probably the most disappointing realization from all this is that despite the strength of that summer rally, it still failed. And I think this would suggest that the most recent bear market rally could soon set off an even more damaging decline. So from a tactical perspective, the next slide covers other evidence that has shifted negatively in recent weeks, suggesting that the next down leg has likely begun. So features that had been supportive of the rally from mid-October were stock participation and momentum. Our preferred medium-term gauge of these factors is Lowry's percent of OCO issues above their 30-day moving averages. That's pictured in the bottom panel here. That number sprang from under 2% in late September to over 90% by November 10th. However, like many other Lowry short-term measures of demand, it encountered an area from which every rally for the last year has been turned back. The decline in this figure below its respective 30-day moving average after a potentially exhausting move for buyers is often associated with at least short-term trend setbacks, and sometimes it just rolls the whole thing over, again, depending on the environment. And not helping matters was the 90% downside day recorded on December 5th, when more than 90% of the NYSE volume and points measures were to the downside. These days are represented, if you look at the top of this chart, by red bars. Notice that the prior two rally peaks were closely followed by at least one of these days. So the way we can think about it is that in the vacuum left by tired buyers after an extended rally, 90% downside days often represent the reawakening of sellers during bear markets. So I think that's really important, again, tactically to see that. And although it's not a proprietary measure, another indicator that lines up really well in terms of timing of bear market peaks of the last year is the VIX. And the VIX index, often referred to as the fear index, bottomed at around the same level, below 20, for the past year. Well, this is only really tertiary to our analysis. It's hard not to notice the alignment in the short term to the price and momentum peaks of the last year. So I think it's just something interesting to see. On the next slide, we'll look at another under the surface indicator which helped to correctly guide our analysis in the last year. As much as it's helpful to understand and examine the market for evidence of internal strength, it's also valuable to understand what's happening with the weakest stocks. In bear markets, weak stocks are actually often the ones to lead the way because they're leading to further downside. They're the weakest. They're the most vulnerable. In the bottom panel, we have an inverted chart that measures the percent of Lowry's operating companies only stocks 20% or more below 52-week highs. Now, we use an inverted chart here to spot negative divergences more easily against the major price indexes. And a divergence is exactly what we saw through most of 2021. To give you another idea of how the market indexes can sometimes be deceiving, this figure reached 30% by the final peak in the S&P 500 on January 3rd. It meant that under the surface of the rising price indexes was actually growing internal weakness, not strength. So totally counterintuitive to the way most people think about the market. This indicator right now remains unfavorable from a tactical perspective, recently reaching levels from which many bear market rallies were repelled. And you could just see that, visually with that blue line drawn across. Now, on the next slide, I'll go over one of my favorite indicators and where it says typical bear market bottoms lie. Lowry's average power rating index, or the APR index, is the average demand score of the more than 3,550 stocks in the Lowry database. It too acted as an early warning, peaking in June of 21. The two other important points that I think about this chart are, one, that the APR index remains in a downtrend, supporting the case for an ongoing bear market, and two, that every bear market bottom since 1949, the APR index's readings at the final bear market low was 25. This compares to the most recent bear market low here that happened in late September of 34, which suggests that the bear market has yet to meet its likely end. It's also worth noting that obviously a lot of bear markets ended at figures much lower than that, many of them in the teens, because I did include cyclical bears along with the bigger, cyclical, what I call grizzly bears. But also worth noting that in addition to being well off this mark, many bear market bottoms had positive divergences associated with them, meaning that the final low in the price index was actually met with a higher reading than the prior index price low. And this basically understates that average that I cited of 25, just to make that clear. Next, similar to what we saw with Sam's chart on VIX spikes and major market bottoms, we examine volume spikes and major market bottoms. So contradicting what some are taught about volume, about 2/3 of the time since 1940, major bottoms have been accompanied by multi-year highs in volume. Lowry uses a 30-day rolling window, which I think captures much of the panic selling and then the start of institutional accumulation around the final market lows. If anything, this factor should be considered even more important than it was in the past, as every major market bottom since 1998 has occurred on volume spikes. With this last volume spike occurring in late March, when we're basically just starting the decline, these historical findings would suggest that further downside before a firm bottom is reached, and that seems likely. Now I want to switch gears to the sector front and what to do with this information if you can't simply get out of the way of the bear market. And to this I would just say, listen, the only thing more difficult than getting the market call right is stock picking. And there are literally thousands of wrong choices when it comes to stock picking, right? But in a weak market, stock picking takes center stage, especially for those who are unable to raise significant cash for long periods of time. Now, Lowry's website is set up with a top-down approach in mind. We kind of previewed that earlier. And after understanding the directional market call and the level of demand selectivity that's out there, we would then start with the sectors. And just note that our sectors are not market cap weighted. So they actually act as a pure gauge of investor demand for that particular attribute or that sector, and not just for the biggest and the safest in each sector. And I think a great example of this difference is in healthcare, which ranks last according to our own Lowry index, which has tons of small microcaps, while the large cap ETF representing healthcare, the XLV, is among the strongest from a power rating perspective. But just think about how many little risky companies are in this space that are not in XLV, where the top 10 stocks in that ETF represent 56% of it. And I think this also represents the point that defense is on the field. And what I have here is Lowry's power rating table, which by default ranks by the power rating relative strength. I think that's the most efficient way to capture the longer term trends of demand and relative strength for our sectors. And this table is updated daily and weekly, so our sector and industry group analysis is fluid and dynamic based on demand and relative strength trends. And into the end of the year, it's not too different than into the prior year end, with energy, utilities, and consumer non-cyclicals having some of the best prospects for the intermediate term. And this also lines up with Sam's points earlier as far as defensiveness goes. And by contrast, sectors either dominated by many small cap issues or otherwise risk on, what I would call risk on sectors, appear positioned to continue to underperform, and those would be tech, telco, and consumer cyclicals, for example there. But I think this table is an excellent place to start for those looking to maintain long exposure through the bear market from starting from a top-down perspective. Now from there, on the next slide, we can click through on from each of these sectors to its component industry groups, and in the process finding really the best of the best of the best, if you think about it that way. Now in 1949, just give you a little bit of background, Lowry created power ratings to measure investor demand for stocks, sectors, and industry groups. And traditional power rating analysis can be great when you're looking at sectors, groups, and stocks, while power rating relative strength, I think, is excellent in serving as a useful guidepost for the longer term strategic asset allocations, confirming some of the sector trends that may already be in place. So visually inspecting each chart using the view charts tool or filtering and sorting the 65 industry groups are helpful in really narrowing your focus, because this is a big place to start. Again, we were talking about top down, you're talking about basically making the funnel smaller and smaller. So next, we'll go through exactly what are those attributes to look to when paging through these charts on these power rating charts. So in analyzing sectors, industry groups, or stocks, we use power rating, which is that dark blue line under price, and power rating relative strength, which is the yellow histogram, to assess effectively the trends in investor demand. Again, not just price, we're talking about demand. The key is looking to these factors more for their trends rather than the absolute figures. And I think that's truer in bear markets as the gaps between under and outperformers tend to widen out dramatically. And using oil and gas producers as an example here, we see that the trend of power rating relative strength began improving in fall of 2020 after years of holding below that relative strength zero line, reflecting underperformance, which was true. There was a long period of underperformance for that sector and that group. Before another year had passed, fast forward, and you can look at that line and that second blue circle there. Before another year had passed, the group was firmly above the zero line, which suggested high probabilities of intermediate term outperformance. Next, using the same group, we can then click through to see its stock components. And I'll have to, here go over some of the screening tools and taking that final top-down step. And if you use this approach, after finding the top sectors, then the strongest groups within those sectors, we can identify the most promising stocks. Again, just using those oil and gas producers as an example, when we click through, we saw 91 stocks, which of course is a lot to look through for anybody. I then used Lowry's stock screening and sorting functionality, in this case choosing to filter for stocks with power rating scores comfortably above the group average, and with power rating relative strength also above that group average. Then I sorted by power rating momentum, which is it's just a 3-week rate of change of demand, and that's just to get a sense for some of those shorter term trends. And this now left me with 32 stocks that I can click the view charts button and examine consecutively to better compare and make decisions using the same basic approach we covered earlier as far as those trends go. All this might help in relative terms as the market's game of what I call musical chairs is still going, but ultimately we wouldn't bet that many areas are going to be bear proof at the end of the day. So with that in mind, let me move on to my conclusion slide. And I think here, the bottom line here is that from what we see from our evidence, this all suggests an ongoing bear market. From a shorter term perspective, the most recent counter trend rally actually appears to be reversing, and we pointed to a few factors to that end. And then I think that, as a result of just kind of where we are, using that top-down selection approach with demand and relative strength analysis in mind, that's just going to continue to be really important as that gap between winners and losers is really wide. And maybe at some point it's just going to be a relative game. In other words, there are certain sectors that are just going to hold up better to the downside. So it's not that they're necessarily going to give you tremendous performance to the upside, but just that they won't lose as much to the downside. So I think, again, in the context of a bear market, that's still really important, especially, like I said earlier, for those who can't just step out of the way and go to cash. And then finally, the defensive and inflation-sensitive leadership is still evident. But like I said, few areas are likely to be ultimately bear-proof. So I think there's going to be some mitigation there, but with a true bear market, ultimately they do end, like I said, with capitulation. And with capitulation, they throw the baby in the bathwater and everything else. So again, not having gotten there yet, I think you can't take too much solace in your stock picking abilities, because at some point they might just come and get those too. But that's, for me, the end of the story. Great to have been invited to speak today. I hope you all enjoyed it, and I definitely look forward to answering some of your questions. So, Ken, would you like to take it from here?
Thanks, Vincent. And just great comprehensive comments, Sam and Vincent. We're going to do rapid fire. We got a lot of questions. There was one early on, and for both of you, it's really the rally we've seen since late September. So was that a bear market rally, or have we started a new bull market? There was a couple questions related to that. So if each of you can respond, are we in still a bear market or a new bull market?
I mean, I'll be very quick and say I'm not sure, because I did show those indicators that would imply that we probably are going to have to retest the October 12th low and maybe even set an even lower low. But I would tend to say that, Vincent, your answer is probably going to be closer to the actual truth.
Yeah, no, I mean, I think that, just with some of the work that we've done recently, and that's why I called, my segment what I did, not out of the woods yet. I think it basically tells us that just given what we saw with this rally, it didn't have a lot of those attributes that you really want to see. It didn't have a real thrust of demand. I think it looked really pretty on the surface, especially if you're looking at the defensive stocks, which, by the way, is not the kind of leadership you want to see in a new bull market, and also those really large and those mega cap names. So to me, there's just a lot of reasons to say that this looks like a bear market rally. Obviously, anything is possible, but if we're just going as, with history as a guide and tendency as a guide, it certainly does look like a bear market rally.
Let me add one thing, Ken. But let's say, you don't want to try to time things exactly. Take a look at 2008, 2009. The low in 2008 occurred on November 20th. We advanced by 25% into January 6th. So many could assume we're in the new bull market because we rose by 20%, only to then turn around and lose 27% into the ultimate low on March 9th. Well, what if you had the unfortunate timing of buying at the top on January 6th of 2009? Believe it or not, because of the speed with which the market gets back to a new bull market, you were made whole once again by June 1st, and you were up by 20% by the end of 2009. So even if you totally blew the timing of getting back into the market, you were still made whole within 6 months, and we're up by 20% 12 months later.
Sam, a couple on sectors. One, first, is it your charts were they on the weightings were equal or market weighted? And then in terms of those that have the worst four sectors underperforming this year, when we look to next year, will they be the top four, or just reiterate what your overweights are?
Right. Well, first off, on those that table that I had, showing the 40-week relative strength on the S&P 500, that was equal weight, but the mid cap and the small cap were cap weighted. The reason I chose the S&P equal weight 500 is that's how CFRA's portfolios are managed and reported on an equal weight basis, and that's how our analysts tend to look at their holdings, is on an equal weight basis. So I wanted to make sure that we're comparing apples to apples. Okay, the four worst performing sectors in the bear market were communication services, consumer discretionary, real estate, and technology. We just elevated our outlooks for the full year, that is, because our analysts look 12 months down the road, not 12 weeks down the road. We have an overweight now on consumer discretionary and on technology. We are maintaining or have new underweights on communication services and real estate. We just believe that there's still an awful lot of regulatory overhang for the communication services area. We also still favor energy, even though it was one of the four best performers, because, as I showed you before, the relative, it's trading at a 51% discount to its average PE. We still believe that there are likely to be supply challenges, and as the economy opens up once again, to see increased demand for energy down the road.
Vincent, here's a good question. The market bounced off the 50% Fibonacci in mid-October. Should we target the 61.8% retracement around 3,200 for the S&P? That's for Vincent.
Yeah, thanks for that, Ken. I think if you ask that question, and most technicians are really focused on price, they're going to give you an answer that maybe would fall into that category of looking at that number. But based on what we do, again, we look under the surface. So what I'm going to do is wait for my indicators to tell me when you've seen capitulation, or in other words, exhaustion of sellers, and then when that is going to be a ripe enough condition to be followed by really explosive demand and breadth. So I actually did a paper on this a while ago, which should be associated with this, called "The Bottom Is Not In," and we talk about those factors and what we look for. So rather than targeting a price level which may or may not hold, just depends on if buyers show up there. I mean, at the end of the day, if that's what we're trying to figure out, it's better to look at that indicator. Where's the demand and supply rather than the price, because at the end of the day, that's what's going to matter. It's not necessarily the level.
Yeah, Sam. The market bottoms how long before the Fed begins to ease historically, essentially going from a rate rise to a rate ease regime?
That's a good question, because, would that fall into the parameters of what I am discussing in terms of a tale of two halves? Going back to World War II, so April of 1946 was the start of the hiking cycle, and so forth and so on. We find that the months between the last cut and the first hike is 16 months, and the number of months between the last hike and the first cut, so the converse of what I just said, is 8.7 months. So that would say, let's say if March was the end of the rate tightening cycle, it would still be within that time frame on average that the Fed could start to cut interest rates by the end of 2023.
So here's a recession theme, one for each of you. First for Vincent. Whether it's a soft landing or a shallow recession, would we still need a strong sell-off or a capitulation to end the bear market?
Yeah, I mean, again, history as a guide, what we do is all just based on probabilities and analysis of history, and that's how we formulate a probability. So if I look at history and I say, we have a long database, we can look back to the 1930s, which is what we do. And if we then use that information from history as a guide, and we say, okay, well, in these situations, you typically would see some kind of a capitulatory event. How that is visualized, I think, plays out in a bunch of different ways, whether it's the VIX, whether it's through the volume spikes that I talked about, whether it's through some of the other indicators that I've gone through here, like the APR index and some of the others. I think that's what you have to really key on and look for. But again, if history is a guide, and I think it's a pretty good one, it's not gospel, but certainly we would trust it more than our gut. That tells us that there is still that event that's on the horizon somewhere. What causes it, as far as the why goes, it's not what we do. But certainly it doesn't seem like we've had that event to this point.
And Sam, for recession and what matters, especially for analysts, is earnings. So in 2023, if we have an earnings recession, which again, I'll ask, does that mean negative year over year? Does that precede an economic recession?
What I have found is that since 1990, when Wall Street started looking at operating results, or what some people call earnings before bad stuff, that it's ended up being coincident with recessions, whereas GAAP earnings tended to be a little lagged. So meaning the recession typically started a shade before we ended up with the year-on-year decline in GAAP earnings. Also, I noticed that there was a question that someone had regarding PE ratios, and those were forward 12-month earnings going back to 2000, and then looking at 12-month trailing PEs prior to operating results. So there is a bit of a combination of the two, but you use whatever history you have. And another thought was, do we end up, if we do bottom lower than where we were on October 12th, October 12th was a Fibonacci retracement level at 3,500. 3,200 is another retracement level on the Fibonacci method. And also, interestingly enough, a 33% decline in the PE ratio would bring us down to 14.9 for the S&P on a forward 12-month basis. And that, too, lines up pretty well with 3,200. So we either retest 35 successfully, or if we break below, I would tend to say that would be a 3,200 level, because that would also be a 33% bear market, which comes very close to the average 35 bear market for bears with recessions.
So Sam, one last one, energy is top of mind for many investors. And is there anything looking ahead that might change your view? So great performance the last 2 years, outperform or overweight looking ahead to next year. Is there anything geopolitical or supply and demand or anything, that this is just going to be tactical for the moment?
Well, I guess if the recession ends up, first off, we get a recession, not a soft landing. And second, that recession ends up being a very deep one, then that could pretty much undo whatever the thoughts are regarding energy. However, I did reach out to our energy sector group head, who said that the belief is that the resurgence in the energy sector should be driven by an increase in demand as China reopens. Also, he sees Russian oil supply constrained in 2023 once local pricing goes above the EU cap, and the U.S. production continues to disappoint. So I guess what would undo that is that we find that the U.S. production starts to improve. We find that China does not reopen, or there ends up being a ceasefire between Russia and Ukraine early in the year, which then opens up the spigots once again.
I could go on for another 20, 30 minutes, but we're past the hour and I need to close. First of all, thank Sam and Vincent for outstanding job, and also for each of you for taking your valuable time to be with us today. There is a replay and more information that you can get. There we go. Certainly, there was actually one question, who is Lowry Research? It is part of CFRA, one of the oldest published technical investment advisory services, and certainly you're welcome to go for a trial there. And Sam's body of work, along with the equity analysis on Market Scope Advisor, where you can certainly visit there. I want to wish each of you a healthy and happy holiday and New Year. We've enjoyed having you all of 2022, and we very much look forward to having you with us in 2023. Take care and thank you.